All of the tension on the US-China trade front, along with elevated geopolitical risk, has deflated the market into the end of the week, with stocks under pressure and the US dollar back in demand on the flight to quality play. Our biggest fear at the moment is the fear of the U.S. equity market in decline, despite the remarkable combination of this week's optimism from the Fed chair about a second-half recovery and his assurances that even if there is no recovery, the Fed will be there to support the economy with an unlimited amount of support. And so, if the market knows all of this and is still not inclined to be wanting to push stocks higher, what's left to prop up global sentiment? We recognize we might be oversimplifying things a bit here. Nevertheless, it's something that has us concerned about the outlook going forward in a market that has relied on Fed assurances to keep it supported for well over a decade. And all of this concern without even talking about any future negative shocks that come rolling around the corner, which demand even more of that unlimited support. Surely there is a price tag to all of this central bank accommodation and government stimulus, and up until this point, investors have been content to not worry about that price tag, preferring to reap all of the benefits while they can. But are we closer to that inflection point where assurances from central banks and governments of more money printing no longer do the trick? Indeed, this is a scary prospect. Perhaps we should look no further than the price of gold for an indication that our gloomy outlook is not entirely unfounded. All the time that stocks have been running higher off the March low, gold has been running higher as well, and doing so in more impressive fashion, making fresh yearly and multi-month highs. And demand for gold isn't about the fashion of buying jewelry either. It's quite clear there is a growing segment of the market that understands the consequences associated with excessive money printing and are looking to rotate portfolio exposure into a limited supply hard asset for store of value. We think the concurrent wave of demand for gold while equities have been running up is something that should be watched very closely and something that could be a major red flag for a more meaningful capitulation in stocks. But all of this will come down to whether or not investors are no longer as attracted to the idea that more stimulus should translate into higher stocks. Markets do a good job of pricing things in, and if the market knows the Fed will be there with unlimited support and is still not feeling great, we wonder if this means we should expect more turbulence ahead. That's all for now.